Pivot points can give traders a key price level to help identify potential entry and exit points. They can also help you identify trend reversals as well as potential breakout points. And even better, you can combine them with other indicators to improve your strategy. Now, pivot points are calculated using the previous day's highs, lows, and closing prices to determine potential support and resistance levels for the current day. Some of the benefits: they provide a clear view of market sentiment by identifying key price levels where buyers or sellers may enter or exit positions. They can help you manage risk by providing specific entry and exit points based on these levels. And pivot calculations, they are widely available online and your charting software program as well. They're pretty easy for novice traders and experienced traders. So as traders, we want to find an edge in the markets. Pivot points are one tool that could help us find that. A pivot point, just an indicator, is used to determine potential support and resistance levels based on the previous day or previous week's price action. Now, trading with these points involves using them as reference points. When you incorporate a pivot points trading strategy in your plan, you can improve your odds of success by identifying these key levels objectively where buying or selling pressure may enter the market. And the analysis of these is pretty straightforward because the indicator does all the work for you. Now, what's the importance of these? They're an objective trading indicator. It takes any subjectivity, any guesswork out of finding these levels that may potentially be turning points in price. Now, the most commonly used pivot points are the daily ones. These are calculated through the average price of an asset over a 24-hour period. The weekly ones, they calculate the average over a week-long period. Monthlies, of course, over a month. So how do you calculate them? Well, daily pivots are calculated on the previous day's high-low close. Again, you can use them as reference points to determine potential support and resistance levels in your trading during the day. It's quite simple. Add the high, add the low, add the close, and divide by 3. Weekly pivot points, these take into account closing price from the previous week, and monthly ones consider price data from the past month. Now, these longer term calculations, these can be pretty helpful in helping to identify major changes in trend points or significant price movements. So let's talk about some pivot point strategies for day trading. And it's pretty popular among day traders, again, because you can quickly identify potential areas of support and resistance. And they can help you determine zones to look for. Instead of looking all over the chart, you've got objective ways and means and areas to look at. Now, the pivot point trading, just using your daily pivots as reference points for trading decisions throughout the day. So here's a sample pivot point day trading strategy. And it's a long only one for this example, and you can use this one as the basis of your own. We're going to look at a 5-minute chart. We're going to use the pivot point indicator, the daily levels. We're going to use a 20-period simple moving average for trend. So you got to wait for the market to open, and you're going to allow for the first 5-minute candle to form. You identify the daily pivot point level, the PP, and the support and resistance levels, S1, S2, R1, R2, using the indicator. So you want to look for a bullish candlestick pattern to form above the daily pivot point. Confirm the bullish bias by ensuring that that 20-period SMA is sloping up. And you want to enter a long trade at the market price if all this criteria is met. Your stop loss is below the low of the bullish candlestick pattern. Take profit, take it at the first resistance level, the R1. Your trade exit, you're going to exit the trade if price reaches the take profit level, of course, or if price breaks below the 20-period moving average. You want to risk no more than 1% of your account. So this example here is a $4 move from trade entry to the R1 profit target. The entry, a simple breakout play on the first pause in a bullish up move. Now, there are other entry methods you can use, trendline breaks, if you can draw one. Notice that the take profit level, the R1, was met, and then price began to consolidate most of that morning. Now, some useful tips would include setting your stop losses at key levels. Pay attention to price action around the pivot points. So with this approach, you'll be able to take advantage of the quick profits without being overly exposed to market volatility. So you want to incorporate other technical analysis tools like moving averages or even Fibonacci retracements. Use multiple time frames for confirmation of trend and signals. Keep track of news events that could affect the market. And develop a disciplined approach with clear rules for entering and exiting trades. And you got to stick to those rules consistently. This is going to help you manage risk and avoid emotional decision-making, which can be the death of many a trader. What about combining pivot points with technical indicators? By doing this, you get to gain a better understanding of market trends and make better decisions on when to enter and exit trades. So one way you can do this is using pivot points with the MACD. This is going to allow you to identify momentum shifts, potential trend reversals. Another option is use pivot point support and resistance levels with the RSI indicator. That's going to help determine overbought and oversold levels. Finally, some traders prefer to combine pivot points with the stochastics oscillator for confirmation. But whatever method you choose, incorporating indicators into your strategy can help increase profitability while minimizing risk, as long as you don't overdo it with the indicators. Now, as a trader, I've looked into pivot points in the past, and I do recommend them, at least testing them with your strategy. I like things that are objective, and that's what pivot points give you. And it's really important to avoid common mistakes. You don't want to just rely just on them or not recalculating them. When you use pivot points alongside other tools and proper risk management, you will actually increase your chances of success in the market. Anyways, hope you hit like, subscribe. Any questions or comments, you can pop them in the comment section below. Thanks for watching.